Welcome back. Did you have a good break? Bienvenue. Welcome back. So we have 3 more hours. Let's see how far we get. I anticipate that we can finish these notes. I'm hopeful. I'm going to finish them by tomorrow. And then I can leave you with the exercises. And then give you one more test, one more assignment. Do next week. And then the following week we'll focus on, I promised I would do something with the debt issue of corporations. So we spent a lot of time on valuation. Most of this course we spent on valuation. First, we learned about finance, how to work with the time value of money to value future cash flows as present values. And then we learned about projects or schedules of cash flows and how to evaluate those using the NPV. And then we learned about other alternative metrics to qualify projects. And then we moved into what I'm doing. After we did project analysis, we created cash flows by reading cases. Now what we're doing is going for R. R is the return. We're trying to determine the required rate of return for a future investment opportunity. That's where we're headed. So we're trying to figure out what is the required rate of return first we're trying to figure out calculating returns, and then we're going to talk about estimating the required rate of return. All right, so 12 people are back. We're in 10 minutes of the class, so let's get started. I left off with the calculation here. What we need to do next is calculate the standard deviation. Does anybody have questions at this point? Any questions? I did mention on May 16 there would be a test in class after 12 or at 12 p.m. They'll they'll let you know. Doran will let you know. And you can bring your calculator, your notes, and your text or your book or whatever book you have. But I think it would not be fair to have your phone or computer. So just a calculator. If people are using their phone as a calculator, you'll have to let me know so we can figure out what to do in that case, right? It will be 2-hour long test. We don't want to keep you in the classroom too long. Okay, so let's look at the weighted standard deviation of these returns. So to do this, we need to use the table, right? Because we don't have this function on our calculator. So to do that, we're going to take the probability of returns and multiply it by the return minus the mean, which is 0.15, which always stays the same, and then is squared. So that's the deviation of the mean squared. Oh, I'm in the wrong place. So that's it. That's my function. Okay, if you're using the phone as calculator, you're going to have to turn off the phone. So you got to figure out, you have to turn off the phone because I can't have you communicating with each other, okay? It's going to be difficult to monitor. So if you use the phone, the phone will have to be off. Sorry, the Wi-Fi. It should be in airplane mode. Will that be good enough? Probably not. I'm going to say cell signal. Okay, so the cell signal and the Wi-Fi should be off. I don't know if airplane mode is enough, but you have different kinds of phones. Okay, so this is the calculation you will make all the way down. There's only 3 values, so this ends up being very simple. So this calculation is the variance. Do you want me to show you again? So there's the formula. Yeah, you just have to turn the cell and the Wi-Fi off to use your calculator. Okay. All right, so that's the variance. So the standard deviation is is that amount. So that means it's 14.14%. Questions? All right, so 14.14%. We find here, I calculate the mean. We got 15%. I started to do the steps here, but then I moved to Excel, okay? And then here, the variance and the standard deviation turn out to be 2%. So now that you know, because you know statistics, I don't have to go so slow. I may appear to be going fast, but you should be able to verify all these calculations, okay? Using Excel or your calculator. In this case, we use Excel. Okay, those are the same numbers as I got here. The mean was 15. The mean was 15. The variance was 2. And the standard deviation 14%. Okay, so any questions? Now, let's look at two assets. We want to combine two assets into a portfolio. Right? Because portfolios, investment portfolios, don't just have one asset in them. They have several. So we're going to begin with just two. And I want you to tell me, what do you see about these two returns? What is the relationship? So we did this with, before I showed you how to do this with the market returns, and I did also market returns and BCE returns, right? But now I just have two assets, asset A, two risky assets, and asset B. What do you see when you look at that chart? What do you see about the relationship between A and B? Aha, very good. Very good. You see that when asset A does well, 30% returns, asset B does poorly. When asset A does poorly, asset B does well. This is an example of negatively correlated returns. So this is now, the data has been presented to you in not as ex post data, but ex ante, so that you have two states of the world. This is a distribution. Only two things can happen, either this pair of outcomes or this pair of outcomes. And because of that, we recognize this is a distribution for possible outcomes, and we have to calculate now the expected return for the portfolio as a weighted average of returns. So what we do is just like before, but we do it for both, right? We did this already, but we only looked at one at a time. Now we're going to do both. And then we're going to consider them together. So first, individually, the expected return is this times the probability, so the return times the probability, plus the return times the probability, and that gives you 6%. So the expected return to asset A is 6% return. So for every dollar invested, an investor can expect 6%, or 6 cents on the dollar. For asset B, doing the same thing, this amount times this probability plus this amount return, and this plus this, multiplied by this probability, and then you sum. And this has a slightly higher return of 7%. So far, we haven't done anything new. So next, let's look at the standard deviation of both of those returns. To compute the standard deviation of both, it's only two states, so it's not so complicated, but you need to use the weighted deviation, the weighted variance, right, would be these returns minus their mean, so the deviation from the mean squared times the weight, and the deviation from the mean squared times its weight. That variance of A is 3.84%. Then for the variance of B, do the same thing, and you get 4.86%. So you can make this table in Excel and verify the calculations. So calculating the standard deviation of A is the square root of the variance of A. That's 19.6%. And for B, the square root is 22%. So B is riskier than A. The standard deviation gives us a measure of risk. So B is riskier than A. So let's put the numbers together. What we have that expected return on A is 6% and B has a higher return with a higher standard deviation, which we expected because higher return is often accompanied with higher risk. In a way, this compensates investors for taking on that risk and incentivizes them to invest. So the question is, which asset should you choose to invest in? Should you choose to invest in the higher risk, higher return asset, or the lower risk, it's just slightly lower return asset? And what makes it risky? It's because if you do just one standard deviation from this mean, you're in the negative returns, right? Just one standard deviation away, you're in the negative returns. Makes it risky. So how do we choose between these two? Well, it depends who you are. If you're a risk-averse investor, when you're presented with two securities with comparable returns, you'll choose the lower risk security. Or maybe you are a risk lover. A risk-loving investor, when presented with two securities with comparable returns, will choose the higher risk security. Now these are close, but how do I compare them? What I'm going to do is to introduce a new statistic that you can use to compare them, or a new calculation, parameter actually, because these are seen as parameters. I'm going to calculate what's called the coefficient of variation. The coefficient of variation is a way of spreading out the risk. I'm going to spread out the risk of A by its return. So this is the risk per percent or per percentage return. So it's 3.27 per unit return. And if I do the same thing for B, I'm going to spread out this risk over its return. It's 3.14 per unit return. So looking at it this way, this is a way to rank the riskiness of securities and using both values and combining them. The lower risk would be B. B is a lower risk. So risk-averse investors would go for B over A. Risk-loving investors, on the other hand, will choose A over B. So we made them comparable because we've scaled them to 1 unit of return. With 1 unit of return, both of them per unit of return, this is the risk associated. Okay, so that's the coefficient of variation. Any questions? So in the exercises that I've given you, you can practice making these decisions. So what if now we move closer to more realistic setting where an investor combines assets into a portfolio? Let's say Well, let's look at the effect of combining these negatively correlated assets in a portfolio. And let's calculate the mean and the standard deviation of the portfolio. Are you ready? In order to do that, we have to be aware that we have to use properties of sums of variables and properties of sums of the properties of sums of variables for the mean and the variance of those new variables, right? What we're doing is adding sets of returns together. So we're creating a new portfolio that is a combination. Actually, I didn't write it here, but I'll write it down here. We create a portfolio. So this is like a new variable that is a combination of returns on A and returns on B. What these mean, X's, because we know what RA means and we know what RB is. Those are the returns for asset A and asset B. But these are the proportion of the investment that goes into either of them. So for example, let's say $1,000 is invested and XA was equal to 50%. Then that means $500 is invested in A and $500 is invested in B. So also this should be the weight of B, right? If XA is 50%, XB is 50%. So the weights have to sum. The weights should sum to 1. I'm going to move this over because I want to be able to write down what I just said. So okay, so 50-50 means 500 invested in A and 500 invested in B, and we create this new portfolio of returns, and the returns would be equal to 0.5 returns on A plus 0.5 returns on B. So that's what we're doing next. So what would be the expected return of these, a sum of variables, and what would be its variance? That's what we have to figure out next. Well, in statistics, I didn't get to teach you this, but I hope you learned that the expected return of a sum of variables is just the sum of the expected returns. That's what this is. That's what this says. The mean of the sum, or I'll say the weighted sum, The mean of the weighted sum of variables is the sum of the weighted means. That's in words what you're staring at in the formula. Whatever you do to the values, you also do to the mean. So if you're going to take the values and you're going to average them, this is effectively an average if you put 0.5 and 0.5, but it's a weighted average the way I'm going to deal with this. Then you also have to weight and make a weighted average of the averages. I'm going to say that differently because I think I'm going to say is the mean of the weighted sum of variables is the weighted sum of means. That's really what I want to say. So this is an example here if we had many securities, because really you don't just hold one security and you don't just hold two, you hold a portfolio, so many securities. So you would have to do this for many, but we're just going to do this for two. So having said all of that, find the expected return on the portfolio, P for portfolio, such that 50% is invested in A and 50% is in B. Well, that'll just be this. And this is 0.5. The expected return of A, remember, was 6%. I'll put the number like this. And then 0.5. And for B, it was 7%. Right? So the result is 6.5% because it's just it's just an average. 6.5%. So now that's the mean expected value of the portfolio holding both securities at the same time. What about the variance? So these are kind of intimidating formula, but I'm going to break it down for you. I'm going to break this down for you. Because what we want to do is combine assets into a portfolio. We have its mean, which was, as I explained above here, the mean of the weighted sum of variables is the weighted sum of the means. So whatever you do to the variable, you also do to the means. The means, that variable is multiplied by 0.5, then you got to do that to the means. Is it the same case for variances? Is it the same case for the variance? Should the variance be Remember, these are the returns and these are the weights. This is how much we're putting of each each asset. So is this true? So is this true? Can I do the same thing for the variances? Anybody know? Did you learn about this? Two random variables, finding the mean and standard deviation, the rules of mean and variances for two variables. You don't know? This is only true in what case? If the standard deviation of A and B is, sorry, not the standard deviation, the covariance of A and B is equal to 0. Or I'm going to write covariance. Oh, that's not going to be visible. Hold on. If A and B are uncorrelated, completely uncorrelated, then this relationship is true. If they are correlated, there's an extra term. And here's the extra term. So notice I use this notation. You can write var or you can write sigma p squared. So I'll just put that down here just to remind you we're going to use the symbols for with the Greek letters. So this is sigma of the portfolio is XA sigma sigma A, sorry, plus, so this is sigma squared, this is sigma squared, this is XB sigma B squared. So that's another way to write it. Something is missing here that this is not exactly true. What would be true, these weights in front, remember how we calculate the variance? It's the square of the deviations from the mean, right? the average squared deviations from the mean. If we have a weight in front, like here, you see we put a weight in front of the variable, that gets squared as well when we make the calculation. I'll show that in a bit. So in fact, it's not exactly the weighted average, it's the squared. This has to be squared here. So I'm going to put that with a, just to remind you that that has to be there. And that's true if A and B are uncorrelated. Remember, because these, the variable is in units, and when we calculate the variance, we make it units squared, right? So these are percentages, but then this is percentage squared. So the weights get squared too in the process. So this formula is really like this. Now, you might not care about this too much, but you should follow along, because if you know these rules, these properties, the rest just follows. For instance, if I want to include n assets in my portfolio, we're going to use the same formula. We're going to adapt the same formula. All right, so what we're going to do, I'm going to teach you how to determine the equation for variance of a portfolio of assets this formula here. Where in the world does this come from? Notice this term. This is the term for covariance of the returns. I can write it like this, or I can write it like this. So where does this come from? What we have to do is consider all of the, we have to think about the variability and account for the covariability. And the way we do that is, I'll show you using this matrix. I suggest you just watch and then watch this video later if you don't follow, because I don't want to lose your attention. So when you use a matrix, I'm hoping you know what I'm doing here. When you prepare a matrix, the first term is always the one in the row, and the second term is the one in the column. So I'm going to consider the contributions of variability from both of the assets. So what I'm trying to find is, what is the variance of RP? In other words, what's the variance of XA RA plus XB RB? Now, when you have a sum of random variables and you want to figure out their variance, you have to think about how they co-vary. So what would this be and what would this be? What is the covariance? I'm going to use, although we are working with ex ante data here, I want to use the formula for covariance that you might be more comfortable with remembering. So I'm going to make this bigger so I can show you. So what is this? This is, if I use the sample, the formulas for the sample results. For the sample covariance, you would calculate the average of let me put it here. Yeah. So you have to take the value, each value pre-multiplied with the weight minus the mean. And the mean would be like this. And then you'd have to do the same thing but what is that? That is just if I can factor out these amounts, that gives me XA and then another XA, and then I get this amount remaining in there. You following? So what is that? I'm just showing you that, oh, this is an RA here. This is RA. I really hope you're with me on this. So what I've done is created the covariance of this amount, and that would look like this if I use the sample formula. It's just less technical if I use this version. It follows for the same thing for the ex ante formula. So then there's 2 of these and 2 of these. So how does that affect things? This is just XA squared times RA minus R. So can't I just move this over here? And in this way, I can see that this is just XA squared var RA. So what happens is the covariance of the pre-weighted return and itself is just the weight squared times the variance. And in terms of the symbols that we're using, right now, that means this one becomes XA squared sigma A squared. And this one, in the same way, becomes XB squared. I have to fix this because I have a B here and it shouldn't be B. There should be A's. This is A. It's just the same. It's with itself here. Okay. So where was I? This is XB squared sigma B squared. So far what we have is, for the formula above, the variance of the sum, the weighted sum of returns, is the sum of the variances with the weights squared. Well, I'm going to use this. Did that wrong. That's what we have so far. So this is what we have so far, that the variance of the weighted average of returns is the weighted average of the variances, but with a square on the weights. So all that's missing is the extra term. The extra term comes from these two. So with the same logic, the same mathematics, I could find that this term becomes XA, XB, and still remains covariance RA, RB. And this term becomes XB, XA times covariance RB, RA. And you know what? These are the same thing. These two are the same thing. So we actually see that there's two of those. I can rewrite the covariance in this way, and it changes nothing. So these terms are identical. Because of the formula for covariance, if I put this deviation from the mean in front of this one, it doesn't change the result, right? Because they're just multiplied. So in the same way, this term is the same as this term. So that's it. That's my formula. That's where it comes from. It's considering the covariability, the variability of assets simultaneously being held, asset returns. So this is the formula that we're going to use. If you're overwhelmed, you got to go back to your statistics or just practice with these ones anyway. This is all you're going to need. You don't have to review all your statistics. You just have to know mean, standard deviation, variance, covariance, correlation, and slope. That's why I reviewed it at the beginning. So this might be something new. Maybe you never saw this before. Do you remember seeing this, anyone? So here's the formula for 2. Now I could do this for 3, I could do this for 4, the same thing. I make a matrix, I include an extra term, and all the correlations in turn, I think about them. Now, I keep on writing XA and XB to give you general results, but we actually know that the weights are 50% for this example. So what remains is just calculating the covariance of assets. Now, you guys should practice making these calculations, okay? So you need to practice filling in or verifying the notes and what's done here. So what we really want is the standard deviation. We have the variance, the covariance term is calculated this way, and then we sum them and we take the square root. That is the standard deviation of the portfolio. So let's do that. Would you like me to do this in Excel? No, I think you guys have to practice. You have to practice doing this yourself. All right, so practice doing this yourself. What you find is that, so you have these terms already in the notes, but you should verify them. For 50% weight, this is your variance for A. With 50% weight, this is your variance for B. And then these are your weights, the 2, and the covariance. Now the covariance you have to calculate yourself. So I'm going to say validate or verify. This is supposed to be this number here. Okay, so that's what you should get. Oops. I was trying to clean it up, but whatever. Okay. Okay, I will talk to the administrators. I'll talk to the dean about it, okay? So, do you want me to calculate this for you? You want to do this together? Let me know. Okay, my question was, do you want me to calculate this? Okay, let's do it together. So we need to get to Excel, and we have some of this, no? Maybe not. So we need this information here in Excel. So I don't think I can take it, but I will reproduce it. Okay, I'll reproduce it. It's funny that this happens. I don't know why it's doing this. All right. I have a new computer and things often surprise me. What is going on? Okay, so let's reproduce this data in Excel. So this is probability. Point 4 and 0.6. And this is the boom state. And this is the bust state. So when the economy does well, what happens? So these are the returns to asset A. And then this would be the returns to asset B. So these are for every dollar invested, these are the returns. So you get 30% for A, and for B, it's negative 10%. And it's negative 20% for A. Sorry, for B. What did I just say? So these are both for A. This is for a boom. So A's returns are high when the economy does well. B is the opposite. And A does poorly when the economy does poorly, but B is the opposite. So an example of negatively correlated returns, can you guys give me an example in reality? What kinds of industries would be negatively correlated? Okay, so some examples of firms that had negatively correlated returns could be maybe well, it turns out that gold companies perform better when gold companies, but let's say gold. Well, so there's different kinds of companies that operate in precious metals, and some of them sell the actual, you could actually invest in a company that mines gold, you can invest in a company, or you can invest in a fund that's made up of precious metals, but gold companies or precious metals, let's say precious metals. So people tend to invest in companies and they bid up the stock of precious metals companies, so gold, silver, platinum, when the economy does poorly, because they turn to invest in something that's, an asset that has historical value as a store of value when things are uncertain, and that tends to happen. So that's an example. This could just be any company that correlates returns when the market does well, asset A does well, but when the market does poorly, this asset B does poorly. So asset B could be an example of precious metal company somehow associated with precious metals. Okay, so let's calculate now the expected returns. Well, we did that already, right? We have those results. Did I put it here? No, we didn't do it there. So we did it. We have A was the expected return for A was 6%, right? And for B, it was 7%. And the standard deviation for A was, now I have to go back, 19.6, and for B, it was 22. So 19.6 and 22. Okay, so we have the means of A and the standard deviation mean and standard deviation of A and of B. Now we want to do the covariance. The covariance means that we have to calculate the deviations from the mean. Let me move this up. I'll do so the returns of A minus the mean of A in one column, and then do the same thing for B. So what you have to do is take the return minus the mean. Actually, I want to do this as, I'll do it as 6%. So I can do this in percentage. Let's see what happens. Okay. And then I'm going to do the same thing here. And then here I'm going to take the return for B minus 7% and then copy the result here. And now what I'm going to do is multiply them together and add in the probability. So I'm going to do this. I'm going to take the probability times the deviation from the mean of A times the deviation from the mean of B, and there are the values. And then I'm going to sum them. It's not that bad, is it? And there it is. This is the covariance. So you can review that video to see what I did. So we got that value. I didn't need these, but anyway. Those are my results. So let's go back and put these things together in the formula. The formula says the square of the variable, the squared weight of asset A times the variance of asset A plus the squared weight of asset B times B, and then 2xa xb, and then this covariance term, and that gives us, so we did this together just now, right? And then putting it all together in an equation, we just got this. You get this is the result. Take the square root and you get this number. So now what you have is that the mean of the portfolio of assets so I'm going to add it to this chart here. So you have here I'm going to use the decimals because it might be confusing that I used percentage for everything. So 50% of each, then the expected return on the portfolio with 50% each was 6.5% return, and the variance was estimated at 1.22%. Now, how does that compare to holding the securities alone? Doesn't it seem better to hold the securities together? Look what you do to the risk. You went from about 20% to 1.22, and this is as a result of that covariance term being negative and reducing the variability of the returns. It's exactly that when one does well, the other one does poorly, so they compensate each other. This is an example of diversification. So this is just to remind you, if you want to find out the formula for the variance of returns in a portfolio, and you have n assets, you just have to expand the matrix to find the formula. So if you did 3, you'd have to have XA, RA, XB, RB, XC, RC, and then, so follow what I did, follow the pattern. You don't have to be a mathematician, it's just a pattern that you follow, and you can derive the formula yourself. So what have we found? We've discovered that we can do, this is the variance before we take the square root. The variance of the portfolio is much smaller than the weighted average of holding those assets independently. It's much smaller, all owing to that covariance term. So this means that by combining A and B into a portfolio P, we can eliminate some risk, mainly due to the covariance term. This is an example of diversification, a strategy designed to reduce risk by spreading the portfolio across many investments. So what we found is that there is risk that we can diversify away, and we refer to that as asset-specific risk, or unsystematic, unique, or asset-specific risk. But there's risk that we cannot diversify away. So just combining assets, you can combine 10, 20, 30, 40, or even randomly, and you'll see that as much as you study how to balance them and diversify risk away, there remains some sort of risk. And I'll demonstrate what I mean by that. Well, I've been talking for an hour and a half. Okay, let's take a 5-minute break. Let's take a 5-minute break before I get into it. Wow, time flies. So lots of stats, okay? This is where it comes in handy. So if you didn't learn it, or you didn't learn it properly, this is your opportunity. Let's take a 5-minute break. All right, I'm back. Okay, so any questions? So we could do some record keeping, right? And this is what analysts do. They have information on past prices, and they calculate returns. Expected returns are estimated for different assets, different risky stock, calling them risky assets or stock. And they could examine them and figure out how to pick them in a way to best diversify. The question becomes, does it really have to be done in a specific way? What about if we just chose assets at random? So financial economists did this kind of experiments. And what they found, here's a sample. In this study by Elton and Gruber, published in 1977, this is a seminal paper. What they did was use a database of a great number of securities, over 1,000 of them, and they programmed the computer to go in and pick a sample of securities, and with that they computed the expected return and the standard deviation of returns. So this is just a sample. This is what they published, that they went and randomly chose one and recorded the standard deviation of that asset. Then they went and sampled another one and recorded the standard deviation of that asset. And they did that for several samples. And then they took the average of all those samples, and what they got was 49.2. They did the same thing for different amounts of assets. So here's just marked 10. Here, with 10 assets, what they did was they programmed the computer to randomly choose 10, and then they recorded the standard deviation of a portfolio of 10. Then they went and randomly chose another 10 and recorded the standard deviation of that portfolio, and they did that in repeated samples. And on average, the average of all those standard deviations was 23.9. And they repeated that for as many as over 1,000 assets chosen at a time and combined in a portfolio. So these calculations were made, mean and standard deviation calculations were made for up to 1,000 assets combined in repeated samples. And these are the averages of the standard deviation. So what do we see? We see that the more combined in a portfolio, you realize diversification. The standard deviation, the effect of diversification is that the standard deviation goes down for the portfolio. But beyond about 25 assets, it doesn't go down anymore. It levels out. It levels out. And there's this portion of risk where here it showed 19.2% standard deviation of the portfolio. 19.2% was not diversifiable. This non-diversifiable risk is systematic risk. This has to do with the market itself, not with the individual securities or with their unique risk or their diversifiable risk. So what we really are interested in is picking stocks so that they reduce systematic risk, not just that diversification, because this can be done even, well, this is not exactly effortless, but with low transaction costs, you could just even randomly choose up to 25, that's what they're saying, on average, and diversify away risk. But picking securities beyond there, you would have to consider how those securities interact with the market. So what you want to do is reduce market risk. All right, so now you're going to see something familiar. Remember the tables that I used to review statistics. And the tables involve this company, BCE, Bell Canada Enterprises. And this is an index representing market performance, and it also reflects the performance of a portfolio of stock in the stock market. In fact, there's 500 of the top performing companies are included in the index, and their returns are tracked. So these are calculated, as I mentioned before, and available. And I just have two states of the world here: the good state and the poor state of returns. So what are we going to do? We're going to introduce the idea of market risk. The total risk, again, is the diversifiable risk plus the market risk. We assume that diversification is costless, thus diversifiable non-systematic risk is irrelevant. This is not where the choice is made, that we have to really consider. Investors should only care about non-diversifiable or systematic market risk. Market risk is measured by beta, the sensitivity of market changes. And as an illustration, I've just used two observations here, but you remember from our exercise I had 5, right, observations. And here, if I plot my 2 observations, I plot here and here, I can visualize a line. So back to what we learned in statistics and the correlation, I can visualize a line here. There's a linear relationship. There's only 2 observations, and I could actually calculate the slope of the line very easily here because there's only 2 observations. And in this case, it turns out, if you make the calculation, that the beta, or the slope of that line, is 2.5. Notice it's not, there's no units here. It's not a percentage. It's 2.5. What does it mean? Well, when we interpret slopes, we say a 1 unit change in the horizontal variable results in a 2.5 unit change in the vertical variable. Remember, I told you that you always put the market returns on X, and you always put the security on Y. So we have the market returns and we have the market returns and we have BC returns. So as I mentioned before, this is just 2 observations, but we could have more. If we had more, right? If we had more, then you would have to use the formula that I taught you. Oops, I gotta get rid of that. The one that we learned for slope is, or let me write it in simple terms and then I'll put it in the Greek letters. So its slope is equal to RSY over SX, which I explained spells risk. You can also write that in the Greek letters, but so if it's a scatter plot like this with data all around, you have to use this. But if it's just 2, you can just calculate the slope that's here. So to avoid confusion, I'll erase the ones that are not in the exercise. But okay, so what does this mean? It means that BCE returns are sensitive to market changes. This is important. If there's a 1% change in the market returns, that's X, BCE returns change by 2.5% because they're on the y-axis. However, the same happens if it's negative. If for a negative change, so when the returns in the market drop by 1%, BCE returns will drop by 2.5%. That's a lot. Okay, so this makes BCE returns very sensitive to market. So how do we incorporate this in helping us choose securities for our portfolio? So a portfolio of all assets in the economy is a market portfolio. In practice, a broad stock market index such as the S&P 500 is used to represent the market. Sensitivity, beta is the sensitivity of stock returns to the returns on the market portfolio. So this is the slope ends up being a measure of risk or sensitivity. We have 2 formulas for the beta. This is the one that you've learned in Greek letters, which is analogous to the one that we learned in statistics. Okay, this is the R, this is SY, and this is SX. If I substitute correlation with this, what is this again? This is analogous to R equals covariance of X and Y divided by, I'm not going to be able to fit it. Let's do it again. This is analogous to R equals to covariance X and Y divided by SX divided by SY. So it's the standardized correlation. Standardized covariance, sorry, gives you the correlation. So if I substitute this into here, oops, if I substitute this into here, this simplifies to become this. So what is this doing? This is spreading out the risk associated with market returns over the covariance of security I's return with the market returns. So this is a measure of sensitivity of the stock returns to the market portfolio returns. So these formula are familiar to you. I just use different notation. And what do we do about it? What we do about it is we develop a model for pricing assets. This is known as the capital asset pricing model. What we're going to say is included in this equation here. Rational investors will hold T-bills because T-bills outpace, that's what this represents, the return to T-bills. Remember, those are the risk-free assets. So T-bills have a expected return of RF, and it's not expected because it's always the same, okay? It's going to be always the same. And their beta of T-bills is 0. Can someone tell me why? So we said beta was a measure of the sensitivity of returns to the market returns. Because T-bills are uncorrelated, so T-bills, remember, are the guaranteed bonds issued by government. So the government borrows money by issuing debt. People buy it and give them they give them three months. In 3 months they get the face value. The bond matures and they receive the face value of the bond. T-bills do not respond. Their returns of T-bills do not respond to market volatility. Okay, if you remember back to, let's see if I can pull it up, this chart here was this chart over here. T-bills are moving along here, and they're always above, mostly always above, right? It looks like they're always above 0. If you see what I'm tracking, they do not regard the volatile. They don't go up and down with the market, or they don't respond to the market. They just do their own thing. You see? They go up and down a bit. But presumably, we're going to use the result that they're uncorrelated with market returns. So because of that, the beta, the sensitivity of returns to investors in T-bills, will not be affected by market returns. So we'll say the beta is 0. So back to my equation. So in this equation, investors will invest in T-bills to be incentivized to invest in other assets, risky assets, identified as the market portfolio. So to invest in the market portfolio, a diversified portfolio of assets, risky assets, stocks. An investor needs to be compensated by this. What is this called? if you've been following, what does that look like? We calculated that earlier today. I think I'm going to stop here until someone tells me what that is. Make sure someone's following along. They can possibly explain it to others that aren't. What is that called? Where did we see that today? Go back through your notes. What is that called? That I've highlighted in red. Nobody? Let's go back. Let's look at the notes and see where we saw that before. So we talked about different asset classes. And remember, we calculated this. We calculated the risk premium for different asset classes. What is the risk premium? It's the return, expected return, historical return in this case, to the to this asset class minus the return on treasury bills. So this is the risk premium, and because in this example, in this expression, we are calculating the risk premium for the market portfolio. That's what this is. This is the risk premium for the market portfolio. Okay, that's what it's called. So, to incentivize an investor to invest in asset I over and above his investment or her investment in T-bills, they would need to be compensated for every unit of risk inherent in those securities as measured by the beta, the sensitivity of that asset's returns to the market returns. And they would be compensated by the market risk premium. So let me show you, before I explain what's on this slide, this is what we're talking about. I've plotted here risk and return So this is a measure of risk, beta, and this is a measure of return. This is a way of portraying the trade-off and the choices available to investors. So investors invest in the risk-free asset here, but they have all these other possibilities available to them if they're prepared to take on that additional risk, you see. This is the market portfolio. So this is the expected return that you can calculate. Usually I give it to you because the market portfolio involves many assets, and combining them is, we understand it theoretically, but I don't want to spend time on that. I'll give that to you. And we know that the beta of the market of the market portfolio is 1. Why is the beta of the market portfolio 1? That's one question. And I already told you the beta of the risk-free asset is 0. So this is beta M. So you have the risk-free return and the risk-free risk plotted here. And then over here you have the market portfolio with the beta of 1. Now, any questions? This is known as the capital asset pricing model. All assets are priced on this line. And that is because investors will choose a combination of holding T-bills and the market portfolio. If they're here, all they've invested in are T-bills. If they're here, all they've invested in is the market portfolio. Anything in between these two is a combination of the risk-free asset and the market portfolio. Beyond here, in a portfolio beyond here is the market portfolio plus, well, I'm going to talk about that in a second. But there are assets. So all I've talked about is the risk-free asset and the market portfolio, but all other assets can be found along this line, theoretically, because I can create any of the assets, any of these returns along this line for the given level of risk, as long as I mix together and combine in a portfolio the market portfolio with riskless T-bills. So what am I talking about? I need to know you guys are with me. I don't see much discussion or questions, so it's hard for me to know that you're with me. So what we're going to do is calculate a few things, and then I will explain more about what we have. All securities are in M, the market portfolio. All investors have the market portfolio in their portfolio since they are all investing in the risk-free T-bills and the market portfolio. Okay, so they combine, investors combine riskless and risky assets to meet their risk tolerance, their preference for risk. So it is the case that investors are only concerned with the expected return to the market portfolio and the standard deviation of the market portfolio, and with the contribution of each security I to the market portfolio in terms of the contribution of systematic risk measured by beta and the contribution of expected return. So this captures the adjustment process, and we can use it to estimate the expected return for any asset. This means we can use it to estimate the required rate of return for any firm. Okay? So what we're doing is we're going to use this, call it pricing. We call it pricing because how do we price assets? How do we price stock? Remember the equation. We price depending on the first cash flow or dividend and the assumptions that we make, and we need the rate. So if we have the rate, so if we have this and this, we have the price. So essentially, by knowing the expected return, the required rate of return, or let's write that. Knowing the required rate of return, you also know the price. Okay, so we're going to try and find this as a required rate of return here. That's what we're doing. So this I, I'm going to substitute it for oh, that's messy. I'm going to substitute it with, I can write it like with a capital I. Okay, so this now is replacing I, and I'm going to try and find it. So let's try an example, and then I'll just keep trying examples. So we'll talk about this some more in a bit. Let's go to the end. Here we have, I have two stocks, A and B. I give you their beta. These are their risks as measured, their measure of risk as determined by the slopes of a scatter plot. Okay, so these are given to you. So these were the slopes of the line. These are the estimated slopes on a scatter plot. So I give them to you. Now, giving them to you, you can use the capital asset pricing model or the security market line to determine the expected return or the required rate of return for asset A and asset B. So try that and tell me what you get. I'll give you 5 minutes and then I'll do it for you. Okay, how did you do? Did you calculate? Did you get it? This is the formula we're going to use. And it's the capital asset pricing model. So what we're going to do is, I'm going to move this. I'm going to move it. I'm going to shrink this. No. Sorry. I'll put this at the top. So that's what I'm going to use. I'm going to use this formula. And what am I doing? I am going to, as an investor, invest in the risk-free asset and require compensation of the market risk premium. The market risk premium, I can calculate that aside here using the information from here and here. This tells me that the market risk premium is 10%. So I want to use that here. And let's put the numbers in now. So for RF, I guess I can put that in right away. So I'll put that in here as 4%. I can do this in decimals or in percentage. And I can also put in BA. BA is this. And what do you get? So this becomes 12%, or 0.12 or 12%, okay? So the expected return, so we've priced asset A, that's its expected return, the required rate of return for asset A for that level of risk. What about asset B? Asset B is 1.2, and then no, what did I just do? No. Asset B's RF, it's the same. We copy this, right? That's a risk-free return, and then we want to be compensated by for 1.2 risk by the market risk premium of 10%. And when you do this, you get 16%. So that's 16%. All right. So what we found now, I'm going to plot over on the risk return trade-off chart or graph, okay? So remember that A has a beta or risk of 0.8 and a return of 12, and B has a beta of 1.2 and expected return 16. So the higher the risk, the higher the return. Okay, and that's how you're going to see it here on. So let's see if I put in the values that we saw in this example. Our F is 4%. And it's not a very good scale drawing, but we're going to stick with it so we don't have to invent another one. And we learned that expected return on the market portfolio is 14%, so the risk premium is 10%. That's the difference of those two. Now notice A will be, if we remember, A will have lower return and lower risk with 0.8. So this is not exactly to scale, but I'll put it here. So 0.8. And the return was 12%, right? So it's just under here would be A. With beta A equals 0.8. And I'll make B in a different color. No, I'll stick with blue. Okay, so for B, it's 1.2, so it's going to be up here. This will be B with a beta of 1.2. And notice the expected return for B was 16%. And the expected return for A, which was here, was 12%. So everything, you can see everything on this graph, how it all fits, and notice if you're going to use the capital asset pricing model, you end up back on the line. So if we assume, what we do is we assume that the capital asset pricing model holds. That's what we say. We assume that because there's several assumptions in using the capital asset pricing model, and we have to assume that those assumptions are in place. So that are making the CAPM work for us. So in this equation, what is the slope? Of the security market line? What is the slope of the security market line? What is the slope of the security market line? The slope of the security market line is not B. Beta is actually the x-axis. It's a measure of risk. This market risk premium is the slope. This is my question. The answer is the market risk premium is the slope. So you can see for 1 unit change, in the risk in beta, you have to get back on the line. Your expected return must be adjusted by the market risk premium. So it goes here, and this is the market risk premium. So this difference here is the market risk premium. So the fact is that we say all assets, and if CAPM holds, all assets are on the security market line. What we need to discuss next are assets that are not on the line. How can they exist, or what is the adjustment process back to the line? We'll talk about that. Let's finish this first, though. So what's next? What's next is you can combine assets A and B in a portfolio. I can combine A and B in a portfolio and get its return and a measure of its risk by its beta. And it also has to be on the line. So here's an example with 60% invested in A and 40% invested in B. The expected return is a weighted average of A and B, which gives it 13.6. So these are linear combinations. As linear combinations, they end up back on the line. Similarly, I can calculate a weighted beta. I can put a weight in front of the beta A plus the weight for B in front of the beta B. And I get this. So I could have also used the CAPM. So the CAPM traces 0.96 through the line to find the expected return. And what you will see is that I will expand this. If I was to mix A and B in a portfolio, I would end up back on the line just about here, well below, where 13.6 was the return with 0.96 as the risk. This is a bad scale drawing. My line is even too low, but okay, but it would end up here. So everything ends up back on the line. If you miss assets on the line, you'll be back on the line with the portfolio. So we can trace risk to return, risk to return, risk to return. Any questions? Okay, it's 7:32. What I want to do is talk about being off the line. So let me erase this. I'm going to erase this. Bear with me, because I want to use the same line. So take a screenshot. I'm going to not erase the whole thing, like just clean up a bit here. I can erase A and B. Okay, what if there are securities? I'm trying to erase this there. Okay. What if there's a security like that? We'll call it K. It's not on the line. So how is it that I'm saying all assets are on the line, all risky assets, the riskless asset, all projects are on this line, all investment opportunities are on this line. So let's argue, I'm going to defend my point that everything is on the line in this way. K currently has this level of risk. Doesn't really matter the number. And for that little level of risk, investors would expect this level of return. Now, if they're not getting it in K, they could create it. They could create it by investing in the market portfolio, and over here, beyond the market portfolio, they do something known as, I will write in a different color. What's called short selling. They short sell T-bills. And from here to here, they buy T-bills, right? They're going to own T-bills and the market portfolio and combine them to choose the appropriate level of risk they're prepared to take for their risk tolerance. So between here, this is going to be where they buy T-bills. In buying T-bills, this is known as risk-free or riskless lending. Okay? Over here, short selling, they create a mechanism where they can have risk-free or riskless or risk-free borrowing. What is short selling? Short selling is where an arrangement is made with a broker. A broker matches buyers and sellers of securities. An arrangement can be made with a broker to borrow T-bills. The T-bills are borrowed and then they're sold, and the proceeds are invested in the market portfolio to expand the possibilities here. Okay, so in this model, what I'm doing is combining risk-free and the market portfolio. I'm going to clean up some more. Let's get rid of A and B information so I can talk about K. So the assets in here, or sorry, I erased my so the combinations in here. So if I'm here, I'm invested only in T-bills. If I'm here, I'm only invested in the market portfolio, but I could be half and half. And just like we mixed assets for a portfolio, we would do the same for our portfolio of risk-free and risky assets. So in that case, we would have to have a weight. A weight a weight on F and a weight on M. So let's say I put $1,000 into a portfolio and I spent 500 on the risk-free T-bills. That would make it 50% would be the weight that I would use. And for the market portfolio, since it was 500 for the T-bills and I only invested 1,000, that means this would also be 0.5. They have to sum to 1. Okay? And that could create a new portfolio over here that is 50-50. 50% in T-bills and 50% in the market portfolio. Okay, knowing that, how would I create this? Let's say I wanted to create this portfolio here and substitute it for K, because I want this level of risk, but I want this high return that's promised by the CAPM. So I could create this. How do I create this portfolio? Let me just make a couple other points so you can follow. Here, what would be the weights? In RF, the weights would be XF would be 1 and XM 0. You see they still add to 1, but I have more weight I have 100% weight just buying T-bills. And here, XF would be 0 and XM would be 1. So what about this one? What are the weights to achieve this portfolio? So I didn't tell you about closing the short, did I? So for shorting T-bills, while you're thinking about that, borrow T-bills from broker, use the proceeds to invest in the market portfolio, and then you return the T-bill to the broker. You have to purchase the T-bill So what happens in between is the cash from selling. Oh, I didn't even write that. So what you're going to do is borrow the T-bills from a broker, and then sell them. You're going to sell them. You're borrowing and selling them. And then use the money, the cash made from the sale, to invest in M. And then later you return the T-bill to the broker. Over this time, the price of the T-bill goes up because initially it's worth less, and then it's worth the face value, correct? So in the meantime, the hope is that this return will exceed the price, the return implicit return on the T-bill. So it's not going to be difficult to buy it and return it to the broker. So having said all of that, so again, the T-bills, you borrow T-bills from a broker and sell them and use the money to invest in the market portfolio. So in the absence of financial markets, you can create risk-free borrowing. Okay, so I haven't talked about financial markets per se, like a bank where you can borrow money. I'm talking about a marketplace where T-bills exist and risky assets exist. And I found a way to borrow money at a risk-free rate and invest in the market portfolio. So what would be the weights that would be assigned if I was to invest by short selling T-bills and purchasing the market portfolio, investing in the market portfolio? So something like let's say let's say we want then so this is like we're leveraging creating leverage. So let's say you want to invest 1,500 in T-bills. Sorry, not in T-bills, in the market portfolio. Or let's just do it like this. Sorry. If the weights are, let's talk about the weights. So if the weights go from XF of 1 to XF of 0, then being up here, it needs to be a negative. It's going to go to a negative. This reflects the short selling of T-bills, whereas the market portfolio is going to be a ratio of 1.5. Together they still sum to 1, but this negative reflects that we are short selling T-bills. I have some examples like that that you will see. So how am I going to calculate those? So still, let's see if I can make this bigger so you can follow. So if we borrow $500 worth of T-bills, we have to pay them back. that will give you negative 0.5, right? And for the market portfolio, you're going to put all of that towards the market portfolio, and that's how you get the 1.5. So what I'm saying is, if an asset, this is a stock in a company, it's company K, and if it exists, investors who are comfortable with this level of risk, this beta, would expect this portfolio here, this return up here, and that if K is not giving it to them, they're going to sell K and create it themselves by mixing the risky market portfolio with short selling T-bills to acquire this return here. So what's going to happen to K? What's going to happen to K is that investors holding K will discard of K, they'll sell K, they'll try and get rid of K. And as a result, there'll be a down pressure on K's price. So what happens if we use our regular model, and I'm going to, as promised, use this as our required rate of return, then if there's downward pressure on its price because everybody's selling K stock, then what we're going to see is an adjustment. The expected or the required rate of return will go up. So for K to survive, that's the adjustment process. As people move out of K and create their own portfolio here, if they want to retain this level of risk, this is the required rate of return. So this is a process by which assets that are currently overvalued experience price adjustments. When stock are overvalued, the price is going to drop, right? If you and all investors know all of everything that's on this available in this chart or diagram, and they're aware that K is currently overvalued. So what should they do as a result? So we're going to pick up this discussion, and I'm going to talk about assets over the line as well. So I'm going to pick up and I'll review this next class in the morning. I will see you. If you have any questions, you've been very quiet. I know it seems like a lot, but you have all the tools. This is just applying your statistics tools in finance. That's really what this has been. Okay, what I'm going to get you is an example of T-bills, and then we're going to pick up here next class. So with that, I'm going to say good night because it's 8 o'clock. So I'll pick up and repeat this next class, and then we'll do some exercises together, and we'll get into the last set of notes. Don't be overwhelmed, you just have to practice. Good night, Anouk, Sever, Marcel. You're such great students. I just hope that you can absorb all this. I think you can. You just need a good rest. Bonsoir.